Dear students, I welcome you to my video lectures. Today I will talk about chapter number 13, which is capital budgeting techniques. For project evaluation methods, there are mainly four different methods. One is payback period. The second one is internal rate of return. The third one is net present value, and the fourth one is profitability index. In my last lecture, I talked about payback period. In today's lecture, I will cover internal rate of return. It's a very important topic in project evaluation, and it's a widely used technique. Before going to internal rate of return, I'll talk about payback period. I'll give you a quick recap. So if you remember, the first and foremost thing, whenever you're evaluating a project, the first thing you have to draw a timeline. All cash flows, cash outflows, in fact, you have to put a minus sign. Outflows, positive signs. So there are mainly two different methods of calculating payback period. One is called the cumulative inflows method. In this technique, what you do actually, you are mostly concerned about the inflows. So for example, if I invest $40,000 today, in the first year I'm getting $10,000, and the second year I'm getting $12,000, and similarly 15,000, 10,000, and 7,000 for year 3, 4, and 5. So the cumulative inflows, what you need to do, in the first year I'm getting 10,000. In the first 2 years I'm getting 22. So how did I get this 22? 10,000 in first year and then 12,000 in second year. So in the first 2 years I'm getting $22,000 back. For the first 3 years I'm getting $37,000 back. How? 22,000 plus 15,000, which is $37,000. And then in the first 4 years I'm getting $47,000 back. And if you see my initial investment of $40,000, I'm able to recover this investment between year 3 and year 4. So my payback period is somewhere in between. And the way we calculate it is, of course, as I said, first of all, you have to identify the 2 years on the timeline in between which the payback period lies. So the lower one is actually 3 years. So my payback period is a little more than 3 years. So I label it as A. So the way we calculate it is payback period is A plus B minus C. B is here. And then C is $37,000. I apologize. 37,000. So the whole point is this $3,000 I'm actually getting in the fourth year. And in the fourth year in total I'm getting $10,000. So the fraction of that year is 0.3, which means that the payback period is 3.3 years. So plain and simple. The other technique is actually cumulative cash flows. So the previous technique was cumulative cash inflows. This one actually takes into account all cash flows. So if you see here, my initial investment is $40,000. When I get $10,000 back in my first year, my outstanding investment is $30,000. Second year, I get $12,000 back, so my remaining is minus $18,000. Third year, I'm getting $15,000 back, so my initial I'm short $3,000 of my initial investment. So this $3,000 actually goes into fourth year. So whenever this amount, the cumulative cash flows change sign, so it is minus sign and now it's plus. It means that at the end of the fourth year I'm actually making $7,000. How? because 10,000 plus 12,000 is 22, 22 plus 15 is 37, 37 plus 10 is 47, and if you see, my initial investment is $40,000, so 47 minus 40,000 is $7,000. So the whole point is, I'm only concerned about these $3,000, and these $3,000 I'm getting it back between year 3 and year 4, and then I'm using exactly the same technique to calculate my payback period. So it is the lower limit, which is 3, and then fraction of the 4th year. So $3,000 divided by $10,000. And as I told you in my last lecture, let's say if in the 4th year, if I was making, let's say $20,000 here, let's say 20,000, then I would replace it by 20. So it's nice and simple. Major weaknesses. One of the major weakness of the time value of money is, one of the major weakness actually of the payback period is it does not take into account time value of money. So if you see here, we are not discounting these cash flows. I'm only working with those numbers without applying any time value of money. And it does not consider cash flows beyond the payback period. So if I go back to my timeline, and if you see, I'm only concerned about a period until 4. I am not taking into account 5th year. So I'm ignoring all the cash flows, let's say, which are occurring well and beyond the payback period. So that is the second major drawback in payback period. Internal rate of return, which is the topic of today's lecture, it actually takes into account the major drawbacks of payback period. So it takes into account the time value of money, and actually it takes into account all the cash flows. So not the cash flows until a certain period, but all cash flows. Internal rate of return is a discount rate which equates the present value of all cash outflows with cash inflows. So the initial cash outlay, what you need to do actually, you need to discount all the cash flows, and then you have to equate it with the initial cash outlay. So essentially what it means, that what is the interest rate or what is the internal rate which I'm getting by investing an initial cash outflow. And I'll give you an example, then it will make it super easy. It's not that technical. So Julie Miller, same example, she is evaluating a new project for her firm, Basket Wonders. And she has determined that the after-tax cash flows for the project here will be $10,000, $12,000, $15,000, $10,000, $7,000, respectively for each year, 1 through 5. And initial cash outlay will be $40,000. So if I put everything on the timeline, what it really means that today she is investing $40,000. So it's an initial outflow, so that's why it's with minus sign. And then the first year she is getting $10,000, 10K. In the second year she's getting 12K. In the third year she is getting 15K. In the fourth year she is getting 10K again, and in the fifth year she is getting 7K. So if you remember from the payback period was actually in between 3 and 4, which was I think 3.3 if I remember correctly. Now in order to calculate the internal rate of return, what you need to do is you have to discount all the cash flows here. So if you remember from chapter number 3, you have to discount all the cash flows here. And since we do not know the interest rate, in fact that is our main concern, and that interest rate will be our internal rate of return. So the interest rate which equates all the cash inflows, so this side is actually cash inflows and this is cash outflow. So the rate which equates all the inflows, the discounted inflows to initial cash outlay, that interest rate is actually called the internal rate of return. And since we do not know it, so we will go with trial and error basis as we discussed in chapter number 3 and subsequently in chapter number 4 while calculating the yield to maturity for bonds. So let's try with 10%. So if I discount all the cash flows, $10,000, $12,000 and so on with 10%, these are the numbers that I'm getting. And you have to multiply $10,000 with present value interest factor annuity, which is this factor, and you can get it from the table at the end of the book. And once I calculate all the cash flows, as you can see, it's $41,444. My target is actually $40,000. So since there is an inverse relationship, so inverse relationship between IRR and the present value. So let's say if my target is to bring it down, what I'll do the next time, I'll try a higher IRR, a higher interest rate. Let me put it that way. So let's try 15%. So as you can see, with $15,000, sorry, with 15% interest rate, the present value of all cash inflows is $36,841, which is less than $40,000. And then we can use interpolation, and the way we do it is, first of all, we plot numbers. So with 10%, my present value was 41,441, and then with 15%, my present value of all inflows was 36,841. And since my target is 40,000, why 40,000? Because this is the initial cash outlay. So what rate will actually, at what rate, if I discount my all inflows, will make it equal to my initial cash investment? So if you see the difference between 10% and 15% is of course 5%, and the difference between this number and this number, so upper versus lower, is 4,603. I'm interested in this part. So suppose it's X, because I have to find it out. That's why we label it as X, which is a variable which can be anything. And the difference between these two is 1,444. So the logic is this 0.5 makes a total difference of, so 4,603 makes a difference of 0.05. Then how much 1,444 will make a difference in terms of like percentages? If you would like to do it mechanically, the way you do it, anything with the larger square brackets like X and 1444, divide them by anything outside. So X divided by 0.05, and then 1444 divided by 4,603. So this is the mechanical way of doing it. You divide all variables and numbers inside the square brackets by numbers outside the square bracket, which are these numbers. So if I calculate it now, x is 0.0157. So this is 0.0157. So I have to add it to 10%. So my IRR is actually 10% plus 0.0157, which is 0.1157 or 11.57%. So what it really means that if I plug IRR as 11.57%, it will equate all my cash inflows with initial cash outlay. And since I told you in one of my lectures that interpolation actually is an approximation, so it may be a little bit different. It's an approximation, it's not an exact number. So the IRR of this simple project is actually 11.57. Just like any other project evaluation technique, IRR also has acceptance criteria. It has a cutoff rate. It is also called hurdle rate. Cutoff rate is the minimum required rate of return, and please pay attention to this required. On investment in a discounted cash flow analysis, the rate at which a project is acceptable. So for example, Basket Wonder thinks that a similar project, for a similar project they will need at least 13% required rate of return. And if you can see, the calculated internal rate of return is 11.57%, which is less than the required rate of return. So as a result, this project will be actually not accepted, so it will be rejected. And the reason it is rejected, as I said, the required rate of return is actually more than the internal rate of return, or in other words, the project return is 11.5%, where the minimum required was 13%. So that's why it was rejected. There are some weaknesses of IRR technique, and of course there are some strengths as well. So one of the major strengths is it takes into account the time value of money. The other major benefit is, of course, it considers all cash flows of the project life cycle, and of course it's little bit compared to other methods, it has less subjectivity. All the cash flows on the timeline are forecasted using a certain process, and of course with some certain assumptions. These cash flows are pretty accurately, I would say, estimated, and therefore the subjectivity in IRR technique is comparatively less. One of the major weaknesses is, of course, the project assumes that all the cash inflows will be reinvested at the same IRR. So if I may draw another timeline, and let's say at year 5 there is a project which gets you, let's say, $10,000 cash inflow, and at year 10 it also gives you $10,000 cash inflow. So IRR would assume that we should apply the same IRR for a cash flow at year 5 and cash flow at year 10. In reality, actually, cash flows which are appearing in the shorter term, they are less risky compared to those cash flows which are, let's say, occurring at year number 10. So using the same IRR for a cash flow at year 5 and same IRR for cash flow at year 10, it's a very strong assumption, and it's one of the major weaknesses of IRR technique. The other weakness of IRR is difficulties in project ranking. And the reason it's difficult to rank different projects, of course, every project has a life cycle. So suppose we start a project today, and then year 1 we are getting some money, year 2 we are getting some money, year 3 we are getting some money, and let's say at year number 4 actually we invest some money here, and let's say it's an IT project. It's an IT project. So normally IT component of the project is more risky. So here the IRR, or let's say the required rate of return for the project, changes. So in real life we may be actually dealing with multiple IRRs even for a single project. And project ranking difficulty, the reason it's difficult, because let's say if there are 2 projects, one is, let's say, project 1, the total cost of this project, let's say total initial investment is $100,000, and let's say there is project number 2, here the initial investment is, let's say, $1 million. Suppose the IRR for this project is 13%, and this one is, the IRR is for project number 2 is, let's say, 12.5%. And of course every project has a different cutoff rate, so it's difficult to rank those projects. For example, here the cutoff is, let's say, 14%, and here the cutoff is only 12%. So based on the cutoff, actually we will accept project number 2, but we will reject project number 1. But let's say if we are ranking projects based on only IRR, of course project number 1 looks more lucrative because the IRR here is 13%, and in project number 2 it's only 12.5%. But if we compare based on the riskiness, and of course if the risk of the project changes, its cutoff also changes. For project number 1 it's 14%, for project number 2 it's only 12%. So acceptance based on the cutoff, of course we accept project number 2, but if we rank it based only on IRR, it will rank high. Project number 1 will rank high because it has a higher internal rate of return. So in order to sum it for you, one of the major weaknesses of IRR is we cannot rank projects, and then the project life cycle, sometimes it has multiple IRRs, and then we cannot simply reject or accept project based only on IRR alone. Let's do some Excel exercises. And so suppose I copied this question from the book. It's question number 1. So it's a stove company. So a stove company is considering a new product line to supplement its range line. It is anticipated that the new product line will involve cash investment of $700,000 at time 0 and $1 million in year 1. So 2 investment outflows at 0, $700,000, and then in year number 1, $1 million. After-tax inflows of 250,000 are expected in year 2, 300,000 in year 3, 350 in year 4, and 400,000 each year thereafter through year number 10. Though the product line might be viable after 10 years, the company prefers to be conservative and end all calculations at that time. So if I put all the numbers here on a timeline, we can calculate a rate of return in a very simple Excel command. Before we proceed there, I would recommend all of you to do something actually with Excel. So enable some add-ons. So add-ins. So go to File, click Options, and then go to Add-ins. And if you see here, Manage Excel Add-ins. So go, and if you see here, there's Analysis Tool Pack for VBA, and then some currency signs, and then solver add-in. So click on Analysis Tool Pack, and then click on solver add-in as well, and then press OK. And once you go to data, you can see that there is an icon. It's called solver, and we will use this actually as a method number 2. So in order to calculate the internal rate of return, I plotted all the cash flows here, and my timeline is here. Remember, the cash outflows, we always have to put minus sign in front of it. So it's minus $700,000 and then minus $1 million. In order to calculate internal rate of return, always start with equal sign. So whenever you press equal sign, Excel already understands that you're trying to apply a formula. IRR, it gives you a suggestion, double click on this one, and if you see here it says value, so I'll select all of my values, then comma, and then it says guess, and guess is very important, and I'll explain it to you shortly. So let's say my guess is 10%, 0.1, and when I press it, of course I get a number which is 13.20%. Guess, why guess is important? So the computer actually assumes 10%, it starts its first calculation at 10% and try to see whether the discounted cash inflows equals actually the discounted cash outflows. With 10%, of course, it wouldn't be equal to that. So what it does, it applies a iterative process. So what it does, it adds, let's say 10.5. In the second step, let's say it tries 10.5. Suppose again it doesn't equate. It applies, let's say 11%, then 11.5, then 12. So Excel actually, through internal rate of return formula, it tries to zero in on the internal rate of return, which equates all the cash inflows to cash outflows. And of course, if I'm talking about cash inflows, I'm talking about discounted cash inflows. So this is method number 1, super simple. Start with equal sign, IRR, double click on IRR, and then value. So give the range of values, and then guess. Guess can be anything. So let me guess actually, let's say with 0.09, which is 9%, right? Gives you the same answer. It gives only a reference point to the computer. The first calculation starts with that number, and then the computer uses an iterative process and then zero ends on the internal rate of return. There is another method of doing it, and let me enlarge it a little bit for you. And the way we do it, so let's start with any random number. So let's say 9%. And for project evaluation, as I said, you have to calculate the discounted cash flow. So let's calculate all the discounted cash flow. So this number divided by 1 plus, and then this, I'm using this 9% rate, and then raised to the power time, it's 0 here. Now the most important part is actually we have to lock this F1. And why log this F1? Because we'll be using the same rate for all calculations. That's why I'm locking this cell. You can log the cell with a shortcut, which is F4, or maybe you can manually put a $ in front of column and then in front of row as well. And then if I double click here, it will, and this is called NPV. We will cover this topic in my next lecture as well. So if I add all the numbers, this is net present value. So if I add all numbers, and the way I add it, of course, auto sum, it's 343,767. My target is actually 0. So the way I do it, go to data and go to solver. And what's my objective? Set objective. So objective is set C13, which is this cell, which is already highlighted, to a value of 0 by changing which number? Of course, F1. And if I solve, of course, it uses the same iterative process, and then it calculates you this number. So super easy. There are two different methods. Of course, the first one is more easy. It gives you the answer right away. But this technique is also very, very helpful, especially if you are finding it manually. So it starts with, of course, 0.09, and then when it solves, it uses the same iterative process. Try different numbers, increment it a little bit, or decrement, like decrease it or increase it, and then it tries it to 0 in on a number which makes the NPV equal to 0. Although it's not 0, but it's very, very close to 0. Okay, so this is end of my today's lecture. I hope you learned something. If you have any questions, I'm sure you must have some questions, so drop me an email, send me that question through WhatsApp, and I will talk to you in my next lecture, and we will cover net present value in that lecture. Until then, take very good care of yourself, and I'll see you very soon actually. Thank you.